get started here because it's just a couple minutes after 5. So thank you all for coming. And if anybody is watching on this live stream, because we are now live streaming this event today, so we're super excited about that. We welcome you guys watching via the web as well. So I'm going to start, we're going to introduce our panel members here, and basically what happens is I introduce the panel members. I'm going to start with a question that was actually emailed to us prior to the event. And then after we answer that question, if any of you in the audience has a question, just raise your hand. I'll come to you, pass you the mic. You're going to ask your question to our experts, and they'll answer it. So, pretty simple. So we do have Jeremiah Beckerman. Sorry, Jeremiah. He is a wealth management banker at U.S. Bank. He has degrees in both accounting and economics from Metro State University in St. Paul, Minnesota. He's been involved in a startup venture, spent 6 years in private and public accounting, and has nearly 11 years of banking experience with personal lending, small business, and private banking. Next, we have John Hines. He's a financial planner with Charter Point Wealth Strategies. His business is in West Des Moines. He's been there since 2003. He's a graduate of Simpson College with his wife, Michelle, graduated from DMU's DO program in 2008. He focuses his practice in the medical field and works with residents and fellows in constructing financial plans to help them manage student loan debt, protect their income, and strategies to achieve their goals. Next to John, you guys might recognize Dr. Kate Heineman. She joined Des Moines University in 2013. She is the chair of the O&M department, clinician, and an assistant professor. She earned her Doctor of Osteopathic Medicine degree from DMU, where she has also completed a 1-year O&M fellowship. She then completed her residency in NMM and O&M at Mercy Health Partners in Muskegon, Michigan. Next to her, we have Michelle. And Michelle Price is a real estate agent with Iowa Realty, full-time licensed realtor in the Jordan Grove office of Iowa Realty. She earned her real estate license in '93 and has helped hundreds of clients. She is an Iowa Realty Hall of Fame member, a President's Club member, and has been an award winner consistently since '96 with Iowa Realty and with the Des Moines Area Association of Realtors. What Michelle loves best about her real estate is that it truly is a service industry, and she loves creating sincere relationships with her clients, putting their interests first and exceeding their expectations. And then finally, we have Magda Leopold, Wells Fargo At-Work Program Manager. She began her career as a personal banker, specializing in credit and budgeting. Her passion for helping others with their personal finances has led her to her current position as a Wells Fargo At-Work Program Manager. Magda delivers unbiased financial education that is focused on changing a person's financial habits and behaviors, helping them make better informed financial decisions. So thank you all panelists for being here today. Like I said, I did have a question emailed to us prior to the event. So I'm going to start with that one, and then we'll get it rolling with our audience members here. This student says that he has money in an employer-sponsored retirement account that he has separated from to attend school. He said it's under $1,000, and he's not obviously currently employed since he's coming to school here. But he's not sure what to do with that money. Should he roll it over into a form of an IRA? Should he withdraw it and pay off some of his student loans, or should he move it somewhere else?
Well, since I hold a securities license, maybe I'll fill that one. So how employer-sponsored plans work, first thing is you have 4 options. You can leave it alone, which generally isn't the greatest option because you've separated the service from an employer. They don't really care about you much anymore. You probably don't care much for them. And if they change plans multiple times and you move, as students do, it might get lost in the shuffle. It'll eventually come back, but it takes a lot of work to track it down if you let it set for multiple years. So option 1 is leave it there. Option 2 would be to roll it into an IRA, which is a good option. It gives you full control of how the money's invested and where you put it. Option 3 would be to cash it out. If you prematurely cash out a qualified plan or an IRA prior to 59.5, you have to pay tax and a 10% penalty. As a general rule of thumb, I tell people they'll get about 60% of their money. A third option, based on where your guys' income is at, that might be advisable, is to convert it into what's called a Roth IRA. So a Roth IRA is an after-tax dollar, so you've already paid tax on it. It grows tax-free forever. The benefit of that type of account is you can take out your principal at any time. So if you invest $1,000 and it grows to $1,200 and you need to pull $1,000 out to pay a down payment on a house, you could do that without paying tax or penalty. The reason that might be advisable is if your income's pretty low as a student, that conversion rate is not that great because you won't have that much tax to do. But it really is kind of tailored, again, you're going to hear this from me kind of throughout the Q&A, is that everybody's different, but those are the 4 rules. At that dollar amount, a lot of times people have loans that are at 7 or 8%, that it might be worth considering cashing it out, paying the tax and penalty, and paying off some loans.
Okay. All right.
I'm guessing this is a common question for a lot of people, but rent or own while you're in grad school? You rent a house or own a house? Or rent an apartment?
Well, since this goes down to real estate, then you all take that, but, you know, I don't think it's a cut and dried answer for everybody. It really depends on your situation and, you know, how long you're gonna be there. I mean, I wouldn't advise that you go buy a house if you're only gonna be in the city for, you know, 2 or 3 years. I mean, I think it's better to, I mean, I'm in the business of selling real estate, but at the same time, practically speaking, you're not going to gain enough equity in that home for when you sell it to go, you know, do residency somewhere else or get a job somewhere else. You know, and you've got to think about the student debt that you have as well. But, you know, if you know that you're going to set down roots in a certain city, it's absolutely a good thing to do. You know, buying a home is one part of, you know, investing in yourself and starting your wealth.
I would just make a suggestion. When my wife was going through DMU, you know, we stayed in Des Moines for a number of years, and I saw many of her classmates purchase homes and then do their residencies. They didn't match. So now they're leaving Des Moines for Mason City, Chicago, Kansas City, and they're stuck with this house. The other consideration I would tell you guys to think about is if you're not planning, to your point, to stay in Des Moines or the surrounding areas, the time it takes to manage a property, because the common thing is, well, I'll just rent it if I can't sell it. That's a huge time commitment that most physicians can't afford to have. So, you know, it's my personal experience that purchasing real estate needs to be a very calculated decision that we are committed to being here, or we have the means or the time to manage a property after we leave.
It also kind of depends on where you end up. So, you know, with residency salaries, it's fairly standard across the nation, but of course the cost of living is very different across the nation too. So, and I mean, when I was in residency, we found a duplex for $700 a month, which was, you know, very reasonable, but we had to pay on our student loans at the time. So I knew I couldn't, you know, we were putting more than a mortgage worth towards student loans, so you had to factor that in. And even now, you know, I have kind of my home mortgage is the same as my student loan mortgage, so I could have double the mortgage, and I put $3,000 towards both of those things. But that, we'll talk about that down the line. So it depends on kind of, you know, where you're at, how much you're willing to put towards something. I mean, you can put a lot more towards mortgage, but then you can't put that towards student loans.
I would also add, I think from a bank's perspective, are you going to have funds to put on a down payment for a home as well? And so then you're going to be knocking on mom and dad's door. So they're going to probably play into the factor pretty heavily. And that's probably a discussion we can have with the family. And I've seen it go both ways, work out very well, where actually my wife rented when she was in law school in Iowa, and she ended up parking about 15, 20 cars on her front lawn during football games that paid for her entire taxes for the year. And she just kind of cash flowed by renting it to other students. So it can work out, but I've seen it go the other way as well. So again, having personal preference in your situation.
I would just say from personal experience, we bought a house, we did the exact same thing, my wife and I, and then she got a residency at Broadlawns, which provided housing. So we were young married, I bought this house before we were married, and I found very quickly in residency that if I wanted to see my wife, I would have to move to Broadlawns. So we quickly rented our house out, and that's where I come to the time management piece of it. You know, it's it's not just the cash flow in dollars and cents, you can make that make sense, but your time is very valuable, and if it's taking away from being a physician, it's definitely advisable to consider maybe going another route.
So my question's kind of along with the housing too. So we're graduating this year, third year PT students. Looking at houses, I mean, we have the debt, but looking at, like rural health and stuff, you can get a house for cheaper than you could in Des Moines or something like that. So just comparing your salary for a first home, like what would you say with your student loans and stuff? Kind of a range if there's one that you guys usually give, and then kind of to either continue to rent and try to pay off loans or put that money towards owning is kind of the same question, but
So how long are you planning on being there then?
so probably like 4 years is the contract for like the rural health. So they help pay towards some of your loans too, and Iowa matches it, and that's something for DMU. And I think it's up to 4 or 5 years, so so like, I was just looking like, Spencer's where I'm interested in going, and their house is like $50,000 for a 2-bedroom, and then looking at rent, it's $500-600 to rent a place a month, so just trying to decide, I mean, I know it's specific for each different place, but if you guys, for salary wise, I mean, we don't have much money coming out, but would you recommend renting still?
You would be a first-time home buyer, right? So I would say, look at that market. I mean, my market, my specialty is here in Des Moines, so I don't know much about the Spencer market. But, take a look at the market, go out and to open houses and meet realtors and talk to them about how the market is. I mean, is it a slow market? Is it a very active market? And then, I would certainly try to buy under where you're, especially what rent's gonna be. I mean, so I would just try, instead of buying something at the top of your income or at the very bottom, but maybe one elevation above that. Make sure it's a good resale property so that when you do leave, they're going to be able to, someone else is going to want to buy that property just like you do. But as far as the finances part of it, I mean, that's something that you really want to talk with the mortgage officer about, and they'll look at your income and they'll look at your debts. And, they'll be, and your credit, that plays a big part into it too, and they'll be able to kind of steer you in the right direction as far as, what the affordability is for you.
If I can add something to it too, in addition to what you just said, a couple other things to keep in mind too when thinking about buying a house. It may seem to be a less expensive option than renting, but some things you want to pay attention to, what the taxes look like, how much of the insurance is going to be, and most importantly, when you're talking about properties maybe 50 or a little bit above, how much work is it going to need? And if something does break down, and we know it will, how are you going to be prepared to cover that need too, those expenses? If it comes to a general rule of thumb, a number, if you're looking for a number, the recommended number that should go towards your housing is below no more than 35% of what your total expenses are, for expenses on your income.
I was just going to add to your point, the expense of the house is so much more than the mortgage. Insurance, taxes, you have a lawnmower, you have a snowblower, you have a rake. I mean, these are all things that cost $30 to $50, and there's 20 of them that you could go in your garage just to maintain a yard. So, you can take whatever your mortgage payment is and probably put 20% of that away just to pay for stuff that you're going to need to maintain your property.
And then you have big expenses too, like if your heat goes out or air conditioning, that can cost $5,000 or so. And then knowing you'll be on the budget, paying off some of your student loans too, which that should come first for you, then that definitely can put you in a pickle there if you're not prepared for it.
Yeah, I was just gonna say kind of what, depending on what your goals are. So if your goal is to have a house, okay, there's a way to make it work. For us, it was sort of pay off the loans as fast as possible. So our goal was, let's pay off our loan. When we're making a decent salary, we're going to pay off our loans in 5 years. So we budgeted that amount, and then whatever was left over from the income, then we could figure out now what do we have available for a mortgage and all the other expenses and that kind of thing.
So say for students who graduated with a ton of debt, and as far as the debt that you have after graduation, say if you do plan to get a house, or say you do have a house already, do you recommend probably refinancing and tapping into the equity from there to help pay off some of the debt that way, because of the interest on for a mortgage is probably a lot cheaper than credit cards or anything you can think of. Is that something that is a smart way to do that, to be able to pay for it, since you're still going to find a job, you're still, I guess, salary-wise, you're still having obligations to pay for other things, but what are your thoughts about paying off the loan, the big one?
Yeah, I'll speak to this one first. I think there's a couple of factors there. So one thing I'll say is when you shift your student debt to, say, your home equity debt, you're essentially taking away from a government entity and putting it to a private sector. And one point I always like to make is if something were to happen catastrophically and you could not make these payments, you can defer government loans. They are not forgivable, but what is it, forbearable? Yeah. The bank, however, is not quite as lenient. So if you are unable to make the payments to the bank, what happens, it becomes the home that then gets repossessed and so forth. And, this would be a pretty rare occasion, but it's just something to think about when you start considering shifting debt. Would you pay a lesser rate? Probably very likely you would, because interest rates for, say, home equity line of credit, 4%. I don't know, you guys are paying what, 7, 8? So obviously, you cut that in half. And there's also deductions you can take against your income. When you do have debt carried on your home mortgage, you can take that interest and deduct it from your income on your taxes. That's another benefit. However, when you first buy a house, you don't have equity in it, typically, because you're putting your down payment of 20% down, and you're out of cash now. So you just kind of have to factor those things in. Sometimes you can restructure debt from one school to another, in fact. So you can actually kind of scope out different universities, and they may have lower interests that they will consolidate your loans to, and that might be a potential option for you.
Yeah, I would definitely say once you have, once you're beyond residency, just kind of agreeing with Jeremiah, look around. So look around and see what else is out there that you can sell your loans privately. But I wouldn't necessarily do that until you're in a much more secure financial position. So when you're in residency, your income really isn't that great. You're probably not actually going to get much better of a rate to lower it. So when you're out of residency, you have a better income, you're stable, things are going to kind of go in that direction hopefully for a while. That's a good time to refinance and see what's out there, because most likely you'll get quite a bit better rate.
I personally use SoFi. They're very strong. There was another company that shut down in Iowa that loaned out $500 million in a matter of like 60 days because there's such a demand for the refinance. The big thing that I always stress very much is the federal student loans, if you die or become disabled, particularly around death or forgiven, disabled, you can defer. Private loans, you cannot. SoFi is one of the few companies that still honors that commitment, where they will forgive it upon death, which is nice. But as far as the refinance option goes, I guess we advise our clients to use that for emergencies. And as it pertains to, getting in a house, it's important to consider that, you know, you're gonna need a place to live. You don't really want to mortgage your future on your house for a short-term problem. So I would definitely consider those points.
We also went with SoFi, and did drop our, I think we were at 6 or 7% for most of our loans, and went down, but gosh, I think it was like 2.9, which is kind of crazy. But we also did a variable rate, which is kind of risky, but we did it because we wanted to do, you know, such a short time period that we didn't figure it would go up as high. It's up to like 3.7, I think, but we only have 2 years left. So, you know, I think.
One additional comment I would make, you know, because there's a lot of questions about housing and getting into a house. I remember being in your shoes with my spouse and living at 3,000 grand and can't wait to get our first home, and we wanted to paint and do all these things. And I saw a lot of my wife's colleagues and fellow students rush into a house, and then as their income jumps significantly after residency, like 4 times, they have this hamstring of this starter home, and they can't build or buy what they really want because they were in such a hurry to get into a house. So that's something I would consider. I mean, there's a lot of short-term payoff. It feels great. You're no longer in the dorm type setting or an apartment, and that's wonderful. But if you got to take into account that your life and your spending habits are going to adjust very quickly to your income, and you're going to want a nicer house than a starter home in a very short period of time. So that's a pitfall I see where people are kind of hamstrung with this first home, and they can't really buy what their dream home looks like. And they can afford to do it based on the increase in income, but to get a loan is not going to happen based on having the first mortgage you're not going to be able to sell. So that's something to consider.
So I had a question about the public service loan forgiveness program. I'm not sure if any of you are familiar with. One question is, what do you predict the likelihood of that actually continuing on for years to come? And if you do get to the point where you've made 10 years on-time payments, that amount that's finally forgiven, if you might explain how the taxes would work at that point.
You could probably answer better than I. I've had a couple clients that are in their like 9th year, so they're really approaching that. It's my understanding, and I'd have to double check this, that there isn't a tax for what's forgiven. It's a non-taxable event. What I tell people is you have to do income-based repayment on those loans. So everybody gets stars in their eyes that I'm going to have $250,000 of student loans forgiven. You still have to make those payments for 10 years. If you're the heads up I would give you, you know, my wife comes from broad lawns, if you do income-based repayment, those years count. So you can do 3 years of no payment toward your 120 payments. People aren't, the first set of students, I believe, is it this year or last year that the first wave is being forgiven?
Yeah, so in October 2007 is when it was enacted, so it would be 2017 is the first time we will see forgiveness coming. And I will say that we advise you guys to be very cognizant of Congress and legislation because they're the ones that enacted it. They can take it away. They can make changes to it. We do anticipate changes being made. We're thinking maybe 2019, 2020. Yeah, somewhere around there is where we're kind of anticipating seeing some changes made with that. And what those changes are going to be, don't know. They could limit how much doctors, lawyers, master's students make or get forgiven, or they could say starting in X date, you know, only undergraduate students get forgiven, right? So we just don't know what that's going to look like or what that's going to be. And yes, you are correct, John. Anything that is forgiven under public service loan forgiveness is tax-free. And yes, you do have to be in an income-based repayment plan. So just know too that if you did public service loan forgiveness, you're working nonprofit for let's say 4 or 5 years, and then you decide, I got this really wonderful private offer, I'm gonna go work for this private institute. Your loans have grown because under income-based repayment plans, you will see your loans grow. So just be aware of that and understand that when you're working towards this.
I was just going to echo that. You have to be pot committed to seeing it through the 120 payments, because if you switch jobs, it's a very difficult situation. The other thing I would say, is it's not a huge amount that gets forgiven. You know, the couple I've seen are between 30 and 50,000 of $250,000 in debt, which is terrific. I mean, that's a car, right? But to be cognizant and have your game plan in place on what's specific to you, I think is paramount, and to go in with that game plan that I am here at Broadlawns or an institution that qualifies that I'm going to stay. The other thing that I would tell you is to call your lender. I mean, you guys are all paying these people a lot of money in interest every year. And it's your right as a client of theirs to call and ask questions. Most of that I've dealt with my personal clients, they're wonderful to work with. They will answer any questions you have, but you guys are busy people, and that transition between med school and residency is the time to do it. When you have a few months of downtime that you can really concentrate and educate yourself and come up with a plan for it. The other thing I would suggest, unless you're planning on staying in the metro, almost 100% of rural medicine is going to come to the table with some money to help you pay off your student loans, if not all of them.
All right, where am I going? Okay.
When do you guys suggest those future positions for us to get long-term disability insurance or life insurance? And does that matter if you're married or not married, when we should get it or not? And maybe how much coverage we should get?
For personal experience and the work I do, I 100% encourage people as soon as they can afford to make the payments to insure against disability. There's a 33% chance that if you're under 35, you have a disability lasting greater than 90 days before 65. That's 1 in 3 in here. So look around you. You know, there's a person on either side. One of you is probably going to deal with a disability. I'm very passionate about that because I've seen a lot of people that I've dealt with physicians that got through school, got through their training, started working, started making some really good money, and then got sick. You know, and disability, you got to understand, doesn't mean you're in a wheelchair and can't work at all. It means you might be able to go to work, but only do 50% of the hours. Disability income insurance props up that other 50%. The other thing to keep in mind that's very important in disability coverage is if you get it as a resident or a student, it does not integrate with the group coverage. So for example, most of the groups and clinics and doctors groups will have 60% of income replacement in disability coverage for you as a group benefit. If you get your disability coverage prior to starting and having that 60%, it sits on top of your policy. So for example, if you had $2,500 a month of benefit and you got 60% through your employer and you made $100,000 a year, you would get $60,000 from your employer, which generally is taxed. So 60 becomes 45 very quickly, and that 25 would sit on top of it. So net after tax, your income would be about the same as if you were working. So it's very important to get it before you start your first day of work after residency. As it pertains to life insurance, I call it love insurance. If you have somebody you care passionately about and you want to make sure that you're taken care of in the event of your death, you can buy term insurance, which lasts for a period of time ridiculously inexpensively. Like $1 million of coverage for a male or female, just $30 a month maybe.
So piggybacking off that, term or what's the other one called? There's 2 types.
Whole life, variable life, yeah.
Which one would you suggest? Or make sure both?
When we work with residencies, it's a cash flow commitment issue. Term is so inexpensive and it plugs the hole for the time to get you transition to when your income can support a different type of policy. They're all good. I mean, I would suggest that whole life creates some cash value, but that probably isn't primary concern as much as least amount of payment, most amount of protection.
And some term life insurance policies will let you convert a portion of it into a whole life insurance later on too. A couple things you want to look at when you're talking about life insurance is, yes, the person that you're trying to take care of, while you're gone, maybe your spouse or kids or somebody else, how much money they're going to need if you're gone, let's say. But life insurance is something that you want to review on a regular basis, because maybe right when you graduate you have a lot of debt and full mortgage and everything else, you're going to need a lot more life insurance at that point. versus maybe when you're at 40, 45, or 50, and you're getting closer to being able to pay off that home, and you may not need as much. You will have a lot more money in 401k at that time and other places that you can pull the money from versus when you're 30. It's nice to start when you're young because they do your medical, obviously, and you're in a lot better shape at that time, and the rate that you get at that age remains the rate for the length of the term. So they cannot change it even, let's say, if you get diabetes or something else, then your rate is going to be based on when you originally started the life insurance policy.
In terms of recommendation as far as say you graduated out, to me, what kind of accounts or investment or asset or anything like that that you should start looking into, like the Roth, you mentioned Roth was one, start setting that. But are there other type of accounts or any type of investment that is good, although you're not making a ton of money in residency, but you still have that opportunity to take the money, that you earn in residency, I guess, invest or slowly chip away so that you can be financially sound?
Good question. Since I mentioned the Roth, I'll speak to it. As financial advice is a lot like standard of care that you guys have through medical practice. Standard of care would dictate that you have 3 to 6 months of savings to support a short-term, issue. So that's usually where I tell people to start. We're not investing in anything until you have 3 to 6 months in savings. And those vehicles, I'll let the banker speak to, but high yield money markets, are a tool that you can use to get a little interest. Once people have kind of accomplished that and we check that off the list, we then look at their debt load to see whether it makes sense to start paying more. If you're paying a 7% student loan, a good market average, including 2008 with the decline, is probably 7 to 10% gain. So if you're paying 7 in interest when you can only get 7 in the markets, let's get rid of that debt. But the Roth would be, there's not very many recommendations I make that are kind of blanket, but if you can qualify for that and it fits into your budget, again, the power of that account is that money grows tax-free for your entire life. It does not have required minimum distributions, which that applies to IRAs, 401ks, simple SEP IRAs, where you have to start pulling money out at 70 and a half, whether you want it or not. So it inherits very well, inherits tax-free. So it's one of those accounts that still gives us some access, where we're not kissing that money goodbye like in an IRA. What you put in these accounts is important. What you decide to invest in, you really need to team up with how long it's going to be before you need the money. So is this really a retirement account, or am I doing the Roth because it makes sense now, but I might use that liquidity valve. Maybe we should invest in something with a 4 or 5% return with a lot less risk.
And also in residency, a lot of times there is some small amount of retirement benefits, so that's a really good thing to max out, even though your loans are probably accruing higher percent, but that's free money you're leaving on the table. So if you can at least put whatever that amount is towards it, so you get their match, if they have some kind of match, and then just leave it at that. So, you're getting this free money at least, and now, what can I put towards student loans or that type of thing? So at least get yourself through that. But also with the Roth, like you mentioned, the student, you eventually, your income will probably get to a point where you can't contribute to that. So if you can contribute earlier, that's great, because you only have sort of maybe a window of time where you can contribute to that.
Yeah, I would echo both of those points, and just add one thing. When you're paying the taxes on the Roth, you're doing it now, which is at the point of probably your lowest earning potential of your career, and that's why that Roth is such an important vehicle, because when you want to take it out, it's tax-free. Now, if you were to put it in a traditional IRA, you're taxed at the time you take it out, and at that point, you're probably earning quite a bit more, and I think the general consensus is tax, levels are going to continue to rise as well, so.
The only other thing I would mention, kind of back to that 3 to 6 months of income, that's so crucial. I see so many people overlook that because they're like, I'll just put it on a credit card, or, I have these other outlets. It really is important to be a good saver, and I'm talking about savings, not your checking accounts linked to your savings and it sits in savings just until you need to transfer it back. You know, I tell clients to get a jailer account all the time. Go to a bank, don't get an ATM card, don't get a checkbook, have to physically go in there and get your money out because it makes you think twice about what you're doing. So I would start with that jailer account where it's not just a transfer back and forth.
My question is about insurance again. So my parents have a life insurance policy on me now, just because I have private loans and some other things. So does that get transferred, or I'm not sure like when the transition would be of when I get my own and when they have theirs, I don't know.
If they're the owner, they'd have to file paperwork to transfer it to you. So anybody can own insurance on another as long as they have an insurable interest. Your parents have an insurable interest because they'll be responsible for any debts you have if they're your next of kin. Again, to the point that was made down here, you're young, you're healthy now. You know, I'm turning 37 tomorrow and I'm not getting any healthier. So, you know, do it while you're young and healthy. You get the best rate. You'll have the conversion option. It's very inexpensive and it buys you. Really, you're not buying that coverage if you're unmarried or don't have a family yet. You're buying the option to have really good insurance down the road. That's one of the biggest mistakes I see people make because they don't want to spend the money on it. Every day we wake up, we're one day closer to death. So doing it sooner or later
That's
is
an
important.
optimism.
Yeah.
That's kind of like a very broad question here. So all of us are kind of concerned about the amount of debt that we have. And so I was just being blatantly frugal with everything. I was just wondering if you guys had like a tip that we could use like, at least in the next 4 years to minimize our debt or kind of capitalize on some earnings.
So start with that. Who I have for my clients, I have a client base of doctors, attorneys, executives, and I'll just tell you right now, I don't think I have a single doctor in my book that doesn't still have debt on their books. You know, relatively speaking, the younger ones. And I think what you kind of have to just mentality-wise, you have to think of it as an investment in yourself too, and don't be so scared of what that number looks like on your balance sheet. You are going to make fairly good money in a fairly quick amount of time, and believe it or not, you can pay that down fairly quickly as well. So I just kind of warn people not to get too worked up about the balance itself. And there are options like we discussed earlier about refinancing it and getting out of it. But
If it comes to everyday spending, I would recommend maybe not using a credit card as often, even if you think you're going to pay it off later. There's big consequences with using a credit card. I do a lot of presentations on credit, and one of the pictures I like to show typically to a participant is the true cost of a credit card. We did have an illustration that says if you charge $1,000 on a credit card, which is easy to do, right? Like a couple shopping sprees or something else going on, $1,000 is right there. And if you only made a minimal payment, which typically would be around $25 or so, and for the illustration purposes, we say that credit card had 14% interest, which is pretty good for a credit card. You would have been paying on that card for 92 months if you only made minimal payments. So what happens with a credit card, it's very important to understand how credit card interest works. You get charged interest on the top of interest every month. So let's say I made that $25 payment on that card, now my balance is $975. And to keep it simple, I'm going to say the bank charges me $10 in interest. Well, next month I'm paying interest on the top of $985. So it takes really forever to pay those cards off. And if you have the choice of maybe do you really need it? If you don't really need it, don't use the credit card and just wait till you have the funds and you can pay in cash. If you do really need it, that means it is an emergency and you're going to have to use it, but create a plan later on how you're going to pay that off. The same thing with your student loans, maybe starting once you have several different student loans out there and trying to create a plan, how are you going to pay them off? I always like to recommend, I know I hear a lot of different things, people recommend sometimes paying off with the highest interest rate. I always recommend the opposite. I recommend to actually pay off the one with the lowest amount, the one that you can tackle the soonest. So let's say if you have one that's maybe $5,000, then you're gonna say, well, you know what? I can pay this up in the next year. That's a one less payment that you have to make. And now you can forward those funds towards the next loan and then concentrate on the one with the highest interest rate. But it's really about having a plan, how are you gonna get that debt down? You do not want to be paying on the loans for a really long time. The longer the term, the more money you're gonna pay to somebody else in interest versus saving that money for your retirement or for your dream home or whatever else that might be.
Just another thing to add to that, because it is overwhelming and it's hard to kind of see that. But I guess one thing to kind of keep in mind, if you can't, I mean, you can be as frugal as you want, but it's also important to, still enjoy life and all of those things. But one thing too is just to get a handle on your budget. So if you don't know, okay, how much am I actually putting towards food, or what's my car payment? Do I really need that amount of a car payment? Maybe not, or whatever. So those types of things that sometimes if you've never actually looked where you're putting your money, even though you sort of think that's helpful to do, so that when you, and I think John mentioned at another one of these meetings we had in the past that, if you're not good at managing money when you don't have money, you're not going to be good at managing it when you do have money. So, get a handle on things now and kind of see where you are and where you're putting things, and kind of think about those long-term goals. And, if you want to be really aggressive with your loans, then you'll be in a position to say, okay, now when I can, I'm going to attack this kind of full force. I can't do it right now, but hopefully I'll be at a point down the road a little bit where I can.
A lot of the work has been done for you too. I do have some giveaways for you guys. You can come and grab one at the end of the presentation. It's an actual budget worksheet. So all the categories of a regular budget are in there, like your groceries, utilities, and everything else. So if you want to see where your money is going now, grab one at the end, and all you have to do is just plug in the numbers and see.
I would recommend mint.com also. It's a free online resource. It's very popular. It does a fantastic job of helping with budget, and it connects to your bank account, so you can't outrun it, right? There's no lying when that gets pulled in from Wells Fargo, US Bank, or wherever you bank. And I would just echo with all our clients, if you can live on your residence salary, you're going to be able to live on your doctor's salary. The budget is the engine that drives the bus. And if you can get really good when you have no money, it's going to be really easy when you have a lot.
Going back to the insurance policies taken out on parents, or parents took them out. So if his parents took out insurance policies, are they able to transfer to us, or are they void after we're married? How does that work?
They can be transferred, but you got to be careful. There's also a transfer for value rule that's attached to insurance, so you don't want to create a tax windfall. It depends on the type of policy. Let's just assume it's some term insurance that can easily be transferred. If parents are willing to sign it over, it's some paperwork from the carrier, and surprise, you get to start paying the premium.
So my question is in regards to the debt that we accrue. How is there something we should be looking out for to protect our significant other, future significant other, from our obligations that we have, or is it kind of just it's going to happen, or is there something we should look out for?
I think like we kind of touched on, if it's a federal loan debt, is given correct debt. Is that what you're speaking to?
Yeah, or just like I'm not married now, but I plan on getting married. Is that I guess I'm unsure about how that debt transfers from being single to being married.
Once you become married, you get both assets and both debt. Iowa's not a common law state, so I mean those debts would be your spouse's responsibility, with the exception of debt. So that's definitely a good question. I'm not a dating expert, but being cognizant of your spouse or whoever you decide to engage with, their credit scores. If you get really serious, you need to know, what kind of financial baggage is coming to the relationship as well. So That's something that, it's fun to laugh at, but it's a serious thing. You know, I've seen a lot of marriages of clients that I've dealt with, you know, have a lot of arguments because they don't have a clear vision and they don't talk about what their financial goals are. It's important to lay that on the table and say, I have this debt, I have the ability to make this income, you know, what are your debts, what are your plans? One of the major pitfalls I see people make is one of the spouses decides to stay home. My spouse is a physician, I'm staying home. You know, having those discussions early on makes a lot of sense.
If you go to refinance later, however, they don't go off your household income, they just go off your income. So even if your spouse is making something and you think, you know, oh, we're going to get a much better rate, they still just look at your income and your, and probably your, I don't know if your total debt, but, you know, your mortgage debt and all that. Not, maybe not their debt, but that's just according to you.
Yeah, John brought up another good point. I mean, when you come to the bank for a loan, to purchase a home, and you do it with your spouse, significant other, you're both being looked at credit-wise. And you know, it's fine if one person makes all the money and the other doesn't, but you will be looked at, and your rate may adjust based on your credit as a whole together. So maybe on your dating website, you want to just put above 720 FICO home.
On that note, assuming you had the luxury to decide when you want to get married, is there a financially beneficial time to get married for a student with loans?
From a tax perspective, being married doesn't really help you out. You know, it's one of those things that actually might increase your tax liability a little bit. Just from personal experience and knowing, going through it with my wife, it seems like everybody kind of gets married in that transition between medical school and residency just because you have the time. That would be the biggest thing I would suggest. It has nothing to do with finances. It's just you have time to actually enjoy your relationship. Because it was my experience back to kind of owning that house and my wife being in Broadlawns. This was before they capped work hours, and she was gone 120 hours a week. As a newlywed, that's not ideal necessarily, so I would suggest considering that, you know, particularly if both spouses are in medicine.
So kind of building up all these previous questions, for buying a house, if you're not married, would you suggest buying that house with your significant other, you're both being on the mortgage, or would you suggest one person buying it, essentially the other person is like renting it? You know, because what if you do separate ways, or how that all work out?
I mean, if you do buy a house on your own, without your significant other, you know, you're not married, that home is titled to you. So when you go to sell that home, you are the title owner and you are the seller of the property. You know, and again, it depends on your relationship. You know, I've seen a lot of single people that are together, and one person will buy the house, maybe because the second person doesn't have a good credit score, and you know, they'll buy the house together, and maybe the other person will, you know, pay off the mortgage, you know, and it's still your house together. You know, that seems to work out well. You know, but if you're married, then, you know, in the state of Iowa, it's, you know, it's 100% their property, 100% your property. So I don't know if that answered your question.
A way around that also is quitclaim deed. So one person could buy it, you're in courtship, you get engaged, you do a quitclaim deed, you become joint owners of the property.
Another thing to keep in mind too is what kind of a house do you want to buy, because if you're buying a house on your own, they're only going to consider your income and your debt to income ratio, which is what you make compared to what your expenses are. So you may not qualify for as big of a home as you would like to, compared to if you actually apply for a spouse that's working and brings in income too.
More for the bank than anybody else, I guess. If you have a mutual fund, I have a mutual fund, and I could make a significant payment on my student loan when I graduate. It's about 8% rate of return right now. Let's assume that it's still there 4 years from now. Would you recommend doing that or keeping it there? I know you get a tax benefit from the student loan, obviously.
I would speak to time value of money on that. We can't get years back. You know, once we've invested that money, all these are really difficult questions to answer, not knowing some more schematics of your situation, but I would suggest doing a little bit of everything. Don't abandon this really good retirement fund you have down to zero, or this mutual fund down to zero to pay these student loans off. You know, really strongly consider, I'm a big, moderation is key. Maybe you sell a little bit of it to take care of some student loans, but the power of that liquidity gets you later on in life. It's difficult to quantify today. You know, we want to, all my clients, and my wife included, we want to stop the pain of this big amount of debt. It's hanging over us, it's all we think about. What about the interest? Again, it's difficult to fast forward 4 to 8 years down the road when your income is tripled. You know, it's the biggest jump in income I've ever seen next to professional athletes or movie stars. You're going from 55,000 to 200,000. So, you know, as it pertains to the student loan, it's good to do both. It's good to have some long-term savings. It's good to have some intermediate savings. It's great to have a lot of short-term savings and be able to pull from these different buckets to take care of whatever your issue is at the time. I would suggest, you know, you really need to strongly consider the earning power of that money over the course of 30 years versus paying off debt today.
And we probably have time for about one more question if somebody has it. Okay.
So one of the biggest things that I was able to come to this last year as well, one of the biggest things that I've learned is I don't know much about this realm. Finance is not my thing. I remember last year we had talked about, you know, seeking help, seeking a financial manager or someone like that to help you through this. What kind of recommendations do you guys have as far as who to go to, who to find to help you through these situations, and you know, who's going to lead you down the right path and who's going to lead you down the other right path that helps them a lot out too?
I would say with that, you gotta shop around a little bit and meet with a few different people. Maybe have a coffee with a couple of different financial advisors and see what their perspective is like. I believe most of the financial advisors have access to the same products and they have the same investments out there. If somebody is only talking to you about just the investment, it's like, oh, I can get you this rate of return, or I can get you in this mutual fund, this is great. Well, that's probably not a person that you want to be sitting down with. You want to sit down with somebody that's actually going to ask you questions about your financial goals and what is it that you're trying to accomplish, and help you create that roadmap specific to you. So not everybody likes to take the same risks if it comes to investments. You may be more conservative compared to a person that's sitting next to you. So I think really it's picking the person that you click with and connect with, and they're listening to what you have to say and taking that into consideration when they're creating a plan for you.
I would echo that and also say you want somebody that can go with you. So most people that are at DMU go off to residency and then scatter. You know, if you're having a financial advisor is really about a marriage, in my opinion. You know, I want clients that I'm going to be with for the next 30 years and grow with them. So again, what a valid point. I always tell people to start with their bank, because you get a lot of really good advice on how to structure and leverage your debt and repay there. I would also start with calling your lender. You have people that you're already paying for financial advice that you're probably not taking advantage of, and that's the 800 number to the loans you have. You know, getting information on what options are available, you're paying those people right now. As far as financial advisors like myself, I would look for a couple things that I would just throw out there and recommend. Advisors get paid one of two ways. It's very simple. You either pay them for their time like you would a doctor or an accountant or an attorney, or you pay them through commissionable product that they sell you. Those are the only two ways that advisors get paid. So I would be very clear about that relationship and what your goals are. The other thing I would tell you to look at is designation. just like every DO I've ever met would diagnose a sore throat a different way. You know, you get to the same result, but their thought process behind it is different. You want to look for somebody that has gone through training just like you guys have, that holds a CFP designation. There's a number of them out there. It's kind of the alphabet soup of education, I call it. You know, there's so many that I guess I'm a CFP, so I hold that in the highest regard. But look for a designation where they've done some training outside of just getting their licenses, and be clear about what your expectation is. And in today's day and age, you know, fees are foremost of every conversation. Be really aware of what that is, and she made an excellent point. If people are talking to you about products, insurance products, investments, they're not interested in your plan. Work with somebody that is working on a financial plan for you, which encompasses debt, encompasses your liabilities, any holes or gaps you might have in your plan. I have kind of a handout as well as a checklist of things that you should be doing as a student or resident, and it also talks about what to look for in a professional. But I'm a big believer of getting a really good team. It's not just the financial advisor. You need a banker, you need a realtor, you need a property casualty agent, you need a really good accountant. All these people pull into your team, and they should be working together for you.
And I would just add to that is referrals are key. So anybody that's in your life that you trust, that already has a financial advisor, I mean, ask for referrals. Because, you know, a lot of professional folks like ourselves, I mean, that's how we acquire business, is through referrals. Because we've done a good job for, you know, other clients, and those clients will refer our services on. So, I mean, we've gained their trust, and we've done a good job for them. So, the same with a financial advisor. That's how I found my financial advisor, was through a client of mine who, you know, really trusted him. He did a great job, and I've been with him for 17 years now. So, you know, look for whoever you trust, and ask them if they work with somebody that they could refer to you.
And just to add to that, you're definitely not alone in like not knowing, you know, where to begin with any of this. When I was in, I don't know, riding in my car across the country on various rotations, and I would listen to books on tape about financial stuff because I didn't know anything about any of it. And they're generally not too boring. But like there's some classics, classic ones, Dave Ramsey, and he's sort of like a no debt guy. And you know, as Jeremiah said, not all debt is bad. It's just a matter of managing it. And so getting, you know, just listening to a couple books on tape. There's a lot of podcasts out there, you know, different things like that. So you get a little bit of the language. So when you start to meet with people, then you have a little bit of understanding about, you know, just even the questions to ask. Because sometimes you don't even know the right questions to ask. So that's a good start.
Another podcast that I would advocate for is called My Money Mustache. It's a gentleman who worked in Silicon Valley, made a ton of money, had a lot of debt, and decided he was going to retire at 35 and did it. So he gives really good financial advice for people that are in your similar age, potentially age demographic and situation, where there's a ton of debt, a high income probability, and talks about pitfalls. And that's something you can listen to while you're jogging or working out. It's really good.
So if we're talking about that, then I'll add one more to it. Warren Buffett. If you Google Warren Buffett and any of his articles, one of his favorite things to say is, and my favorite thing to repeat, is save before you spend. So when you go on and have that great job and making a great income and you're creating your budget and killing it and you're thinking you're doing everything right, think about it again. Save before you spend. Most of people, they spend money, spend, and then at the end of the month they say, well, I don't have any money to save, or I didn't save as much as I would like to. So try to do it the other way around and you will get a lot harder.
Yeah, I would just add to that too. This is one thing we haven't said today is pay yourself first. So, you know, pay off whatever, all your bills, your mortgage, or, you know, whatever you're going to put towards your loans. Do all that up front because it's not going to be there at the end of the month necessarily. So make sure you get that out of the way first, and then, you know, because the rest of it sometimes gets spent. So
sure does.
Okay, so before I let all you guys go, we want to thank the panel for coming in. So thank you guys so much for being here. If I have any DOs or DBMs in here, Sean, is going to be back next week to give Financial Planning 101 presentation. And if I have PAs, DPTs, MSBS, MSA, John's partner, Matt, is actually going to be in here the week following that to give Financial Planning 101 for them too. So please check out that RSVP on posting. Thank you all so much for coming. We really appreciate it. Have a great night.